Hi, welcome to the Market Alert for Wednesday, the 8th of April 2020. So stocks surrender biggest intraday gains since 2008, October to be precise, as crude oil crashes. So I think crash is a bit overstated here, but certainly it moved lower yesterday. So let's have a look, see what happened during yesterday's session. We're in the pre-market for the Dow. And one of the questions I was asked is, why do I look at the US markets as opposed to the UK? Well, it's very simple. The US is the major powerhouse. Whatever happens in New York goes around the rest of the globe. That includes recessions as well as bull markets in stock markets, etc., etc. So yesterday morning we saw the market bottom out in the pre-market session and then rally up. This is a 1,200 point move or thereabouts in the Dow, and this is before we open up in New York at 2:30, which you can see in the white area there. So immediately the market saw selling, the market moved lower. It retraced 76% of this move down, back up, back through the 20 and the 50 bar moving average, and then sailed all the way down to the 200 MA. No surprise there, our area of support. And this also trading through the R1 of the pivots there as well. So the market found support and bounced, and it bounced 76% retracement from this high down to this low, which we can see there. And the second 76% retracement was from this high to from this high to this low, and then projected back. And then again, once we close below the 20 bar moving average, we see prices trading back down to the R1, the 200 MA, where they find a bit of support. The market attempts to come back, fails in these two bars, and then moves lower. And there was a lack of, there was too much liquidity, I think, or lack of liquidity, I can't remember now. And this forced the market lower at the end of the session there, which you can see, big bar down. And then, of course, the usual trick, the market overnight sailed down, as you can see there, down to the low of the previous day, and then has since managed to stage a recovery and traded up to the DP level there, which is sitting at 22,847, where the market is currently finding some resistance, and we can see the selling there with the red price bars. So in the bigger pictures, we've got some potential weakness there in the daily chart. I thought the market was going to get to the 23,692, to be honest with you, and actually achieve this in the pre-market electronic session, but it didn't quite manage it. However, as we can see, the market's trading back above the 50% retracement that we've got from the high down to the low projected back. And the market's, like I say, currently trading above this. We've got the figures out tomorrow for the initial jobless claims, but today what have we got? Just the FOMC meeting minutes at 7 p.m. This evening. Medium impact news item. I don't think there's a lot that they can say. However, you never know, given the backdrop of everything at the moment, whether they could actually just come out and make any sort of statement. Nothing would surprise me at the moment. And in the weekly chart, we can see that this market is struggling at the 22,948 level as well, which is a retracement from the high down to the low, and then projected back there. And the monthly charts, it's looking fairly stable there at the moment. Incredible given the lockdown at the moment and the shutting the whole of the economic system down, that this market is still sitting here. However, as the earnings come through from next week, if they allow the earnings to be published, you never know, they may delay it, anything to stop the market receiving bad news. For me, this is just the first leg down, and then we carry on. I mean, it'd be pretty impossible, frankly, to not have a significant move to the downside, given that we've never in the history of the world shut down the global economy. So how the markets could stay at this level and then after the lockdowns finished it could do this is quite staggering. But then again, when you think of how much they're actually printing at the moment, where else is it going to go? So anything could happen. But the reality should be that the market moves lower. But like I've said for years in the market alert, they want the market up. It's the only thing that gives hope to people to see that the stock market's going up. It's the barometer of the economy. Even if they've had a shutdown and a fifth of businesses don't reopen and close, wouldn't make any difference, because that money's got to go somewhere and the stock market seems to be the place. But if I was to be a betting man, which I suppose I am in a sense, I would have the market, the sort of rally and then down, and we go and test those lows that we've seen before over here and already got marked up. That would be my guess, because like I say, once the lockdown's finished, and then you get to see how many more people are going to actually lose their jobs, how many companies are going to go to the wall. And like I say, this is an unknown, because we've never had this before. And then, of course, we could always go back into lockdown again. So really, another surge in the virus, and then we're back to where we are at the moment. So who knows? But how they could actually get the market back to the all-time highs is quite simple. It's merely just to keep printing and printing. Whether anybody believes it is another matter. In the implied volatility, this tweaked up a bit yesterday, as you would expect, to 45 yesterday as the market sold off towards the close. There is a video on the implied volatility. I did receive an email yesterday about this. I'll put the link inside of the email for you. And also the color-coded one, you can see there, green still on the implied, as prices remain above the 20-bar moving average as well. On another note, we've got the 10-year 3-month Treasury. This is still in a normal market. This moving slightly higher yesterday. And as we're going forward, we're getting ready to put the blue bars on, no doubt, here, as we start to see the recession being reported. And that's what these other blue bars are here. These show the recessions going all the way back to 1982, where you've got an inversion in the yield curve of the 3-month 10-year. Once it turns back to green, then the recession follows. And it would have followed naturally without the virus. It just means that we're going to have a depression as opposed to a recession. And Deutsche Bank, we haven't looked at that for a while. Let's just have a look here. Just get rid of these. Moment 664, so still holding at the moment. But again, you've got that classic down, up, and then potentially down there as well. Okay, that will do it for this one. With the implied volatility, I'll put it in the description in the video, below the video, then you can find it there. Okay, that's it for this one. As ever, thanks for watching. See you in the next one.